commercial internet was so new and people thought it was like, is this going to be just used for white male nerds? Being someone that is Asian American, born and raised in Queens, I said, well, these communities around race or ethnicity are some of the strongest affinity groups you can think of. I founded a company called Community Connect. We launched Asian Avenue. I ran this company, I eventually raised venture money, eventually sold the business after a 12-year journey. I looked back and said, were my VCs really that helpful? Beyond the capital, no. The more you operationally get involved and know the ground truth, the better the investor you'll be. And then over time, if you build a reputation of being really helpful, you get the better deals with the best founders. And then I started investing then. We started with a $60 million fund and then a $100 million fund. All our deals were New York based. We had 8 unicorns out of the first, I think 35 deals we did. Steve Jobs has this saying, he was like, what he's most proud of is saying no to a lot of good ideas and focusing on truly the most important ones. And so, when I think about my kind of life's work of like, if I can look back and say, wow, these are all the relationships I built. I mean, it's hard not to look back upon and feel like fulfilled.
Ben, it's fantastic to have you today. Thank you for joining the Winners Welcome podcast.
Of course. Thanks for having me. It's good to see you.
Great. So before you were a VC, you were a founder. So I want to talk a little bit about that. You founded Community Connect, which was the holding company for BlackPlanet, Mi Gente, Asian Avenue, some of the largest platforms for those communities at the time. I want to hear a little bit about your journey as a founder and what some of your biggest lessons learned were.
Yeah, I mean, I would say, I was born and raised in New York City. I was born and raised in Queens, went to college in Michigan. I was an economics major. My brother's 7 years older. He basically raised me because my parents were small business owners. They were immigrants. They ran some restaurants and other businesses. So they worked 7 days a week. And when your parents work 7 days a week and they work kind of later into the night, your brother effectively raises you. And so when I graduated college, I was trying to think about what I want to do after college. My brother was working in investment banking, and he said, if you're interested in business, apply for an investment banking analyst job, which I did. And I got into a program run by Merrill Lynch. And during that time, Netscape went public and it was a hot IPO. And I said, that's the group to join. You got to join the tech group because you got to go where the action is. So soon realized that I didn't love banking, but I love what was happening in tech, and then became a founder. And I think what drove me to be a founder was a couple of things. One was, the industry itself was just so exciting. And it was kind of one of these things where, we were trying to take companies public where the founder was 25 and the CTO was 22. And, it's not like they were, operators with all this history, but they just had this perspective of what was going to happen next in the world. And as I was kind of diving in what was happening in kind of the .com kind of commercial internet phase, I was starting to build perspective of, what the world was how the world was going to change. And I thought about kind of this notion of online communities, sort of learning about this kind of concept and saying, well, that should be on the web. And the concept there was AOL was the most popular kind of online service, but you had to download a piece of software. And on this piece of software, you would use things like instant messenger and chat and message boards. And the most popular things on AOL were those community things, but you had to download a piece of software in a walled garden. And the concept was well, shouldn't that be on the web? And when I thought about online communities, I thought about real world communities. And being someone that is Asian American, born and raised in Queens, I said, well, these communities around race or ethnicity are some of the strongest affinity groups you can think of. And so out of my one-bedroom apartment in Midtown, I founded a company called Community Connect. We launched Asian Avenue. I co-founded with a group of friends that I kind of corralled to build this with me. And then we started kind of getting all this traffic to the point that, I kind of used all my bonus money that I had on servers. There was no cloud computing. And then I basically said, oh, I have to raise some money to buy some more servers. So I raised $300,000 from my friends and family. It was kind of like $5 to $10,000 type checks. Mm-hmm. And it was the kind of money that they give you because they love you and not because they thought it was a good idea. They were like, the internet was all new and they were like, what is this community for Asian kids? And so it was more of a relationships of love than making business sense for a lot of these folks, including my brother and my mom, as investors. And so that money just helped us buy more servers and we got more traffic. And I said, well, let me go out and raise money from real kind of VCs. And back then there were no VCs in New York. So I flew out to the Bay Area and tried to get meetings. And if I got a meeting, got left out of the room. They were like, a New York guy coming to the Valley, that was weird back then. The term social networking hadn't been coined yet. So I was trying to explain to him what this concept of online community is and was going to be. And then lastly, I told him in our plan, we were going to launch an African-American site next. And I remember, this is Bay Area, primarily white investors, male investors. And they said, Black people on the internet? Like, that's crazy. And people think that's crazy now, but I'm like on the cover of Business Week magazine, which was popular back then. One of the cover articles was, will women be online, right? So the thought with like the commercial internet was so new and people thought it was like, it's just going to be just used for white male nerds was more of the preconception. So couldn't raise money for 2 years and then finally met with a person in New York, this guy, Bob Goldhammer. And Bob used to work, used to be the vice chairman of an investment bank called Kidder Peabody. And Bob came to corporate headquarters, being my one-bedroom apartment, and he sat down with me and he met with me for like 3 or 4 hours. And by the end of it, he said, I want to invest and I'll get my friends to invest. And Bob was in his early 70s, didn't really invest in tech before, wasn't even using email. I had to fax him everything. And so Bob, made some calls. I talked to some people he introduced me to, some people, I met with, some people I just did calls with, some people I didn't even meet. And these people started sending me money to invest. And so Bob and his friends put $5 million in the business. And I asked Bob after the checks and the wires cleared, I said, why did you invest in us? And Bob said to me, hey, Ben, I grew up in the Bronx. He said he started his career as basically a stockbroker at Kidder and worked there for 40 years until became vice chairman. And he said his success was being like a people person. He really had really understood people. And he said, what you're doing completely makes sense. He's like, I observe the real world. I see how tight and powerful these communities are, and you're just allowing them to do what they do offline, online, which was amazing because you talk to people that work in tech and they didn't understand what we did, but he kind of just distilled it down to first principles and then said, yeah, this makes sense. And then he said, on top of that, he said, but more importantly, I'm betting on you. And he's like, I think you're going to be really successful in your career, and I just want to hitch my wagon to you. Which was incredibly flattering. I was 22 years old. I never managed a single employee in my life. I've never started a company before. And so for Bob to say that, I was like, wow, like, what does he see in me? And I talked to Bob through his kind of journey as an investor. And he had actually invested in a biotech company. It was a penny stock at the time. So, worth almost nothing on the public markets. But it was started by these two brothers, the Waxel brothers, and Tom and it was something that Bob just didn't have any background in biotech, but he just like really kind of was really believing in the Waxel brothers. And so he invested, became chairman, and that company eventually sold to Eli Lilly for $7 billion. And so, I think Bob was in the business of betting on people. And I think he was just more right than wrong. And the amazing thing about people is that they can have potentially, unlimited upside, right? And I think that's how Bob viewed the world. And so I went on, I ran this company, I eventually raised venture money. We got through the dot-com bust and eventually sold the business after a 12-year journey. And then that kind of led me to this period of like then trying to figure out what I want to do next. And, it's an existential moment, right? Like, I sold my startup. I've made enough money where I can have a lot of choices and I'm not forced to do anything. I thought about what I want this next leg of my kind of life journey and career to be. And I thought thinking about what Bob had done about like, betting on people and then helping those people in their journey. I mean, what a gift, what a reward. Like I was like, wow, that's something I would love to do. And so that got me in starting to invest in incubate companies with my own capital starting in, almost 16 years ago. Did that for 4 or 5 years before then starting Primary as a kind of real institutional firm and fund. But yeah, that kind of trajectory as an entrepreneur and the kind of the lessons learned around, especially from Bob and what he was doing was truly an inspiration.
Wow. Well, 12 years is a real run as a startup founder. I'm sure you developed a lot of empathy for the founder journey that you probably carry with you still to this day. I guess, how did that inform how you approach incubation and I guess later Primary? But we can start with the incubations.
Yeah, I would say, on the empathy side of the founders, I came to the conclusion after my 12-year run that I looked back and said, were my VCs really that helpful? And I would say beyond the capital, no. In a lot of ways, there was also some like shady maneuvering where they were trying to get one up on me or whatever. And I remember Bob was much more of my mentor coach, and as well as he always when he saw bad behavior, he called it out. So, I won't name the name of the investors, they're still around, but they agreed on a deal. And then at the last minute tried to change the terms on me. And it was all done intentionally. I found that out later. And I remember when I told Bob this, he was like, screw that, I'll do the deal. Because he just thought it was just such a poor approach. And so I just learned from Bob, wow, you bet on people, you have this deep empathy, and you're trying to really help them in the journey. And when I talked to other founder friends, I was like, this behavior is not unique to me. It was common. And maybe not that bad a behavior, but at least on the notion of are you trying to be more helpful? And if you're more helpful, do you really, I think you better understand the business, you get better aligned to the founder. And I think that's what the journey should be like. And I thought about it from an investor of if I'm more helpful, I'm a big believer as a former founder operator, the devil's in the details. The more you operationally get involved and know the ground truth, the better the investor you'll be. And then over time, if you build a reputation of being really helpful, you get the better deals with the best founders. So I think it guided me onto the approach of, when it came to investing and incubating, that was going to be my North Star. How do you be the founder's first call? And a lot of VCs say that, but I'm talking about how do you get operationally and strategically involved enough where you get to the ground truth, they can be a real thought partner and you can actually really help. And not just throw advice over a wall and hope that it's right. And so that led me to this, process of, all right, I want to do early stage investing. I wanted to incubate. And the notion of incubation for me was also that I realized that founders are doing incredible work, but they actually may not be great at generating up startup ideas. I tell people now, as in, when I was a founder and operator, I was laser focused on my business, right? You put blinders on because you're I got to have super focus. I got to figure the critical things out. I wasn't out there studying business models all day and talking to other founders about, what's the future of their view of the future and of how the world's going to change with tech. And startup ideas is about a lot around pattern matching, right? It's can you go out, see and identify all these patterns and then piece them together and formulate a kind of a new innovation or idea. And so I said, hey, I'm in this position now that if I'm not going to be the founder operator and I'm meeting with founders and I'm, studying industries and business models all day, I might be in a better position to actually come up with ideas and then go to a potential founder operator and say, hey, you want to start something? Here's an idea. Let's work on it together. And so that was very much what I wanted to do as part of the investing strategy, was have those to combine, because they kind of come in sync. The investing gives you that pattern matching kind of capabilities, and you can, from that, generate ideas on your own and then give that to kind of founding talent. So, I carved out some of that capital I made and I started kind of incubating and investing at the same time. And that kind of led me onto this journey for the next 4 or 5 years, which luckily turned out really well.
Wow. Well, you crushed it as an angel. We got Coupang, we got Jet, we got some others. I have to talk about the Coupang story, how you met the founder and what you saw in him and how that even came about, because it turned out to be a massive, massive win for you and all the other investors.
Yeah. So, getting back to this pattern matching side and how it kind of comes together. So here I am. It's 2009. I want to invest and incubate companies. I carved out a couple of $1 million that I made from the sale of my business and said, all right, I'm not going to raise a fund. I'm going to do it with my own capital first. I'm going to prove it out. And I got a call from an executive recruiter that I used to use. And this guy calls me up. He said, hey, I'm doing a search for this company in Chicago called Groupon. And I'm like, oh, okay, tell me about it. And he told me the numbers. And I think Groupon had just launched like 6 months prior. But the numbers were fantastic. And, the company was based in Chicago. And back then, I mean, even now, there's not a ton of, startup activity in Chicago. So I'm like, wow, this seems kind of random. Like this Chicago kind of e-commerce company is like just ripping. And so I decided to study the business, right? I kind of talked to customers, I studied the product, I did a bunch of stuff, and decided to incubate kind of something in the Groupon space, but was going to take what they were doing and apply it to basically moms or parents. I had just had my first child, and when I looked at Groupon deals, I was like, do I need laser hair removal or teeth whitening or ride go-karts? I was like, nah, that's probably not something I want to do. But I was like, but I need to do stuff for my kids, right? And so I was like, oh, there's kids' music classes and kids' haircut places and summer camps, and they can kind of curate and put deals for you and do stuff with your family. And I said, well, maybe I'll build kind of something in that vein. And so I grabbed a product manager and 2 engineers. They used to work for me. I said, let's spin one up. And I was out there going to local businesses and selling deals, right? So I'd go to the New York City Fire Museum and I'd say, hey, you guys host birthday parties for kids. People don't know that. Like, let me run a deal on it. And I literally would sit down and, sell to merchants. So, getting the ground truth, really understanding the business. I knew another entrepreneur, Mark Laurie. Mark was running a company called diapers.com at the time, and a couple $100 million e-commerce business. And Mark was like, hey, this is a good idea. Why don't I market your deals that you do? So it's like New York City Fire Museum deal to my diapers.com customers, and we'll share the revenue. And so Mark was trying to find ways to monetize the audience or customers he was building. And so we did that. We had a partnership. And then so I launched this business. It was doing a couple $1 million of revenues pretty quickly because of the diapers.com distribution. 2 years prior, though, I'd met this entrepreneur playing pickup basketball at Stuyvesant High School. I'd go there on the weekends and get into just pickup games. And there was a guy and his friends that would just regularly show up there. And it just, became friendly. And then he found out what I was doing. And so, his name's Baum and Baum Kim and Baum had was an entrepreneur. He had started a magazine business. He sold that company, and Baum was trying to figure out what to do next. And so he was thinking about tech ideas, and he asked me to grab lunch with him one day, and he ran a couple ideas by me. I don't remember the ideas. Obviously, they weren't that incredible. But you can tell Baum was special. He was just so smart and driven. And so I said, hey, let's keep on getting together, bad ideas around. And, that was a fun part of the journey. Like over the next year, we'd get together and we kind of brainstorm on different ideas. He'd go off, try to research it and come back. And, he'd be like, what do you think? And we'd wrestle with it. And he'd be like, it's probably not worth doing. And we did that for about a year, didn't land anything. And Baum was not working. And he basically decided to go to business school. Just because he was not working, it was like, maybe business school will help spark some ideas. And so while he was in business school, at HBS, at Harvard Business School, the first semester he was in New York. We were catching over lunch, and he said, hey, what are you working on? I said, I'm working on this like mom Groupon play. And he said, what's Groupon? And I told him about it, and he said, hey, do you think this will work for Korea? And I'm like, well, I'm not Korean, but I can, tell you how it works. And then Baum came back a couple of weeks later and basically said, hey, I think this Groupon model could work in South Korea. And he kind of shared with me his notes. And I was like, wow. I was like, you should drop out. And he did. And so he dropped out, and I invested. I joined the board and was helping with the business. And so that ride started about 15 years ago. And during that journey, I was spending a lot of time in Korea helping Baum in a lot of different ways, from a marketing side or how he's trying to scale a product or recruiting, raising money. So I was trying to, again, be more hands-on and helpful in that journey. But I would tell you, I mean, Baum's an amazing, amazing entrepreneur. I mean, incredible slope, first principles thinker, incredible leader. So just to see him now scale that company to what is now a publicly traded company. So, Coupang's a 40, $50 billion market cap. We have over 100,000 employees. It's now in multiple countries now within, a big e-commerce company that's building in Taiwan, and we're in Japan, et cetera. And beyond, it's gone, went from a Groupon model to pivoting to an Amazon play. And so he's built basically an Amazon of Korea and some of these other markets, but also got into food delivery. So it's now one of the leaders in food delivery and similar to DoorDash or Uber Eats in Korea. So just to see his slope and what he's been able to do, and again on that story of like you gotta get the bet on people with almost uncapped upside. I think he exemplifies that in so many ways. So I've got to be on that journey with Baum as an investor and board member. That was a huge win for me, both personally, but then over the course of investing in Coupang, had put together SPVs and got to invest, about $50 million in the business.
Wow.
And luckily, had when the company went public, it was over $1 billion in returns. So really just like, a life-changing event for not only Baum, but also for me. So I definitely am very indebted to, getting to ride on his coattails. And that, led me to then really want to start Primary and figure out how I can take what I was doing as a fairly small operation, somewhat one-man show to can I build something more institutional?
Great. Well, great story, and congrats on that win and all you've done since. I want to talk about Primary's origin story a bit, and I don't think I've asked you before like how you met Brad, but maybe like how you met Brad and what the key insight or the key initial strategy was for Primary would be great.
Yeah. So, interesting enough, I mean, when I was incubating businesses or investing, I got kind of a reputation of really understanding these like daily deal models, like these Groupon models. And there was a whole bunch of startups there. Brad had started his own venture firm. It was called High Peaks. And he had actually started with two other founding partners. They raised an initial fund, like about a $50 million fund. And his two other partners, I think, in that fund lost 95 cents of the dollar. It's a tough, venture's a tough game. That fund ended up being, a 1.5x fund. Brad carried it, obviously. And so his LPs were like, hey, we kind of want to bet on you. And so he became a solo GP. He raised a second fund. And in that second fund, he had invested in somewhat of a player in the daily deal space. And a mutual kind of contact of ours, another investor, put us in touch and said, hey, you guys are investors in this space. You guys should know each other. I think you guys are two of the more thoughtful guys. And so Brad and I had lunch. And it was one of those moments where it was supposed to be like maybe an hour lunch, but you end up like, sitting there for 2.5 hours. And it was beyond just like the space and the deal, but like his perspective of the industry and approach and mine as well. And I could tell there was like a lot of like alignment on like how we were seeing the world or where like venture needed to go and all that. And that was, I think, anchored around this whole concept of like, why I got in the business, was like we had this model, like startups are hard, founders deserve better. And we just thought like what VCs were doing and approaching the asset class, in terms of like really not providing a ton of support in the journey was like where the industry needed to go and who was going to win long term. And so him and I kind of, were one of the few people in the industry that I felt like when we met, we're like, you get it. I get it. Like, great. And so we kept in touch. And then when Brad was a solo GP, I think he soon realized that he didn't like being a solo GP. It's a really lonely job, right? As a lot of people can tell you. And he basically said, hey, let's do something together. So he approached me. And at that point, it was 4 or 5 years of my journey of investing my own capital and doing something out of not like a lot of scale and trying to figure out how to scale what I was doing. And I'd never, started an institutional fund and thought about firm building. And he was like, let's do that together. Um, so we co-founded Primary with that kind of North Star. But we also had this thesis about New York, which was an interesting time. This is 2013 or 14 when him and I got together. And we also felt like New York City was very kind of overlooked as the next big kind of startup ecosystem, which people might feel like this sounds kind of crazy now. But back in 2013 or 14, it wasn't very clear. And so we had this thesis of like, let's be a more hands-on, helpful seed investor, but at the same time, let's also be laser focused on New York because it was a market that we felt like was hitting an inflection point and far from overpicked.
Wow. And 4 funds later, close to 2 billion AUM, if you haven't passed that already later, you guys have done an amazing job building your firm. I'm curious how you have shifted and evolved your strategy over time as you guys have taken on more capital and obviously made a lot of great investments.
Yeah, so we started investing our first fund. It was a $60 million seed fund focused on New York and starting in 2015. And to rewind the clock at that point, 2015, the biggest exit in New York City tech history was Tumblr. It got acquired by Yahoo for $1 billion, right? So we had one unicorn exit in its history. So, people would ask like, why would you want to focus on a market that's produced barely any big outcomes? And Brad and I, our response was, we think it's all about the change. And the thesis was New York was always this great magnet for talent. They just weren't working on startups, right? So we had the best and the brightest, but they were working at investment banks or PE firms and hedge funds and Bain and McKinsey, law firms. And that was kind of how it was until the financial crisis. And when the financial crisis happened, it all started to change, right? And why did it change? 200,000 jobs on Wall Street were lost, right? Massive layoffs, banks going under. Bain, McKinsey, they fired people. They weren't hiring. Even law firms were firing people. I mean, the financial crisis was this catalyst to displace people from the existing industries. And from there, you had a bunch of people that came from those industries that started companies. Mark Laurie worked at an investment bank doing sales and trading, and he left during the financial crisis, started diapers.com, then eventually jet.com, and now runs Wonder and owns the Timberwolves, and Mark's been incredibly successful. Dave Gilboa worked at Allen & Co., and he left to start Warby Parker. Alexa Von Tobel was at Morgan Stanley. She started LearnVest. Jason Finger was a corporate lawyer in New York. He started Seamless, or become Seamless Grubhub. So you started seeing this wave of entrepreneurs hit, but when you looked at, how many venture firms were based here, focused here, I think leading a seed round, and, this is back, a number of years ago, you'd say, you can count them, basically on one hand. So that was the bet. New York was hitting this inflection point that you had this talent, and that talent success was going to breed success. And I kind of saw it firsthand, right? I sold my company during the financial crisis, and then I started investing then. And I met people like Baum and Mark and all these folks. But I was investing in, I was like, oh, wow, the talent that's working at startups is different. The people that recruit is different. The traction are different. And the market was not going to be that competitive. And they gave me a right to win. My network runs deep here. I was meeting founders I had been doing for 4 or 5 years. So that first fund, I think, first 2 funds really, was started with $60 million fund and then a $100 million fund. All our deals were New York based, and we had great funds. We had 8 unicorns out of the first, I think 35 deals we did, which is an incredible hit rate. And they became top performing funds. By the end of that second fund though, and this is going to 2019, 20, we started realizing we weren't seeing all the best deals in New York or winning all the best deals in New York. Why that happened? The secret got out, market got incredibly competitive. And so how did the secret get out? During the build up to the 2020 to 22 kind of IPO era, there were over 50 New York City tech IPOs, right? And then you have really big companies now that were going public, like Datadog, MongoDB. But, you had, healthcare companies like Oscar, you had, consumer companies like a Peloton or Warby Parker, or you had SaaS companies, whether it be like Double Verify or Yext. You just go on and on and on. Infrastructure companies like a Datadog or MongoDB. And so New York proved that it could produce big outcomes. We also at that point had 150 private unicorns, only second to the Bay Area. Those 150 unicorns there were more unicorns than the next 10 markets combined. So people look at that list, they're like, wow, it's so much bigger than LA and Chicago. Like, what about Miami? I was like, Miami has 6 unicorns, right? So versus New York having 150. So New York became the second most important tech market in the world just in a few years. And that, which meant like the whole venture ecosystem was here. So firms started building offices here, or partners were constantly spending time here. And so, LPs would ask me, is like, who's your competition? But everybody's our competition. So there's so much activity here. And so that kind of gave us a time to say, well, the alpha's gone in terms of like, there's a lot more investors here versus supply of great founders. How do we find alpha again? And that took us on this path of, hey, let's really win with scale. And so we took this step back, and then we crafted this strategy around this notion of an industrialized seed market. And what was meant by that was seed was on track to get really big. And so, fast forward last year, the size of the US seed market, meaning how much seed dollars were deployed in the US, was over $20 billion. 10 years ago, that was about $5 billion. So in just 10 years, we went 4x in the size of the seed market. And why did that happen? Well, there's now millions of people that work at venture-backed tech companies, and it could be publicly traded now multi-trillion-dollar market cap companies to your pre-seed companies. And so with millions of people working in tech, you get this like primordial pool of founding talent, and then you have things like AI that you're like your sparks that take that primordial pool, and suddenly new organisms or new startups founded. And I'm a big believer that capital will follow great opportunities. So great people working on great ideas, capital will follow. And especially around tech, where it's been the biggest driver of global economy. So that was the insight of like, well, seed's getting big enough where we can actually scale the size of our seed fund. And the economics in venture is that your budget of what you can actually do as a seed firm in terms of the people you hire and the resources you have is around your management fees. It's usually about 2%. So the size of your fund and getting 2% of that into your fees gives you a bigger budget. And so I said, look, we can scale our seed fund. This current seed fund's 100. We can scale it to probably $1 billion. And that sounded so crazy. But at the same time, I'm like, look, $1 billion seed fund, if you're investing, I don't know, usually you reserve for some follow-on, and you're trying to deploy that fund over, let's call it 3 years. You're deploying $200 million of seed checks a year, let's say. So you would do that over 3 years. You do $600 million in checks. So it'd be the majority of your fund. And then you reserve some of that to follow on the next couple of rounds or next round or so. $200 million of $20 billion invested in the market is 1%. So that framing, people just like lost sight that seed has gotten really big and it's continuing to get bigger and bigger. And so we said, look, if we can raise a bigger fund, we can take those fees and really plow in team and resources. So, most seed funds were run as these like small boutique-y, low, like little resource type firms. And we said, well, how do we start building out resources that can help our founders in a supercharged way? So we have now over 65 people growing to 80 over the next year. And we have like 10 people in talent recruiting. So we directly placed 170 people directly in the portfolio last year. So real recruiters working side by side, hand in, really deeply embedded in our portfolio companies, find them the great talent. We do that with go-to-market. We do that strategic finance. So we do things around, helping them find customers, helping them find great people, helping them raise their next round. And it's those kind of capabilities that allows us to better understand the business, be better aligned, as well as gain a reputation that allows us to work with the best founders. And so that was basically the concept. And that's where, we kind of took the funds and the firm over the last, I'd say 5 or 6 years. So now we manage $1.6 billion. Our most current fund is about, close to $650 million. And so we're kind of on this path of continually kind of scale, which we think is, part of where it's happening with the industry.
And this podcast is brought to you by Gunderson Detmer. For over 30 years, Gunderson Detmer has represented what's next. Built exclusively for the innovation economy, the firm is the #1 law firm in venture capital globally, partnering with leading investors and groundbreaking companies from start to scale. Learn more at Gunder.com.
I wanted to double click on your view of how being a scale firm gives you advantages. And you've touched on some of it, but you have the ops team, you're adding a lot of value to founders, you have your industry-focused partners, but anything else you think that just gives you a structural advantage compared to a non-scaled seed firm?
Yeah. So, if you think about, you're in the business of trying to make money and fund returns are an output, I think about like, what are the inputs? And usually inputs are your controllable inputs. And this was a framework that I learned from Amazon. They talk about goals being outputs, but a combination of outputs and inputs. And they focus much more on the inputs because they're controllable. So what do I mean by inputs? So the core parts of the business in terms of what's controllable and the things you do are seeing deals, picking deals, winning deals, supporting deals, right? So those are basically the 4 things of the job. And then you say, well, how are those 4 things being done now? And with scale, how can you do that 10x better? And that's where that kind of first principles thinking about like, well, we can raise a fund and you can say you can be more helpful and have an advantage, but then how do you execute on that? So on the seeing side, what are investors doing now? They're like, yeah, they maybe throw events or do some content marketing. Well, we have a whole team that, does content marketing, that throws events. So an investor joins a platform and you know what it's like. It's like you're going out trying to tweet on your own or write a piece of content. Well, what happens if we have a whole machine to help you do that and do that really well, best in class? So an example of this is like, every venture firm does events. Let's do kind of one of the like the flagship events in the industry. So we host what we call our primary New York City summit. It's become like, the go-to conference in tech conference in New York. Invite only, 2,000 people come, over 1,000 investors, but founders, operators, brings the whole, not only ecosystem in New York together, but outside of New York, all kind of convene. All high quality, invite only. And it's now become a thing. We're on to our 9th year. So we say, look, you can't do that as a subscale firm. You can do that with scale and have a team dedicated and make sure you can do a best in class. So those kind of things from a seeing perspective, we invest in. From a winning perspective, the research, the thoughtfulness of the picking and the winning, the research, the intel, the staff, the team, all of that is part of that. Winning on top of that, our impact team is not only supporting, which is part of that, but it's also part of the win, right? So like when we give a term sheet out, it's not just a term sheet. Like we show them like, here are customers that we're going to bring to the table. Here are people we're going to help you recruit. Cause like, we kind of call it like a forward deployed motion. Like we learn about your business during our due diligence. And then when we go pitch you, after we give a term sheet, we're going to be like, this is how we're going to be great partners. And that's the stuff when like we do it, they're like, wow, this is different. So all these kind of components pulled together. Now, what else are we investing in? We just built a 4-person internal AI tooling team. We call them Primary OS. And that team is building out AI tooling for our investors. I think everybody in the firm is building out their own AI tooling, but these guys like take it one step further. So we build out like all these AI sourcing agents that are combing through kind of LinkedIn, trying to get signal on who might be starting a company or just started the company. Those agents reach out to people, they're finding out more information, and they're picking up signals from all these other places, whether it be from GitHub or, from if they wrote a research paper or they won some math competition or a whole bunch of other VCs are looking at them. So we're using technology as a way to kind of supercharge that as something in sourcing as well, but we're using AI to, help companies identify customers. So our go-to-market team literally has a process where, like in the sell pitch, they actually build out an app of like how we're helping source customers, and we actually show them customers that we found for them and how we built an application for them. So not slides, not talking, it's like show, don't tell. And we can do that with AI, right? Like literally a full application dashboard that's built out agents reaching out to customers looking for all these signals. So what are signals? Like we were pitching one company that basically sells AI stuff to home services companies. And we can comb through all the Google reviews of that business and figure out who's like the better customer for that issue, and use that to enrich the data to say, hey, this is signal why you should approach these guys, and this is a way to approach them. And here's we built this for you. So it's that kind of stuff that we couldn't afford an AI tooling team to do that unless we had the budget and scale. And that's what it takes to be competitive, right? And so you have to be seeing, picking, winning, supporting at a different level. As the industry has just gotten bigger, founders have more choice. And so if you can't do all those things really well, then I think it's hard to find alpha in the business.
That's so exciting. And one of your titles, or I guess hats at Primary, is Head of R&D and Head of Incubations. I want to talk about how you approach that, and you have a new platform, I think Altis, if I'm pronouncing it correctly. Just want to hear more about the origin story and what all you're doing there.
Yeah. So on the topic of the seeing, picking, winning, supporting, the picking's interesting. It's hard for the entire industry, meaning that it's actually not, venture is not a very efficient market. If you talk about public market companies, right, there's research analyst reports. There's all these companies are aggregating data on companies that you can buy from, whether it be like Yipit data. There's SEC filings, right? So you see 10Qs, 10Ks, it's annual reports. There's just so much information that is now effectively at your fingertips. And I think efficient markets are really important for the market itself. Capital allocation, better alignment with investors and the founders of the companies, or the operators and founders or the leadership of the companies. All that stuff makes for the success of a market. So if you want the market to succeed, I think efficiency is really important. Venture is really opaque, right? Like, if you're trying to, you might read about a company, but then in order to learn about it, you have to get a meeting. And then when you do the meeting, you have to try to do all this diligence on it. And it's pretty tough. So, we saw one company or one firm that was kind of doing some interesting stuff was Tiger Global back, a couple of years ago in the peak of the market. They were deploying like $20 or $30 billion a year. And during that time, they hired Bain to do a lot of this kind of research for them. And so they were paying Bain, well over $100 million a year to do this research. And a lot of that research was being done before the partners at Tiger were meeting with the founders. And so they would do all this research on a company. And a lot of it was first-party research, talking to customers, talking to former customers, competitor customers, talking to former employees, talking to other investors in the space. So they were building like a full perspective about the company before meeting them. When they did do a meeting with the founders, they showed up with all this research. And the founders were like, whoa, you kind of know a lot about my company. And they were actually learning something. They were like, oh, wow, I didn't know my former customer said this, or my competitor customer said that, or this is how my former employees think of me as a leader or manager. They were like, wow, this is rich. And founders, they want to navigate and they want to have investors that really understand their business as part of that. And so Tiger was winning deals, one, because they were, paying really high prices, but at the same time, that research definitely impressed and opened doors. But, when you think about that, it's like, well, they're able to do that because they were deploying $30 billion. They were having all these fees. And so they can afford that research. Well, maybe we should create a firm, and a research firm, and make that research available for all investors. And so let the research be about finding alpha in a very inefficient, opaque market, but around making the market more efficient and transparent, and be a beta product. Let it be market beta. And so that was the genesis of the idea for Altis. So we co-founded the firm, or I co-founded the firm with this guy, Chris Freeberg. Chris was a equity partner at BCG, Boston Consulting Group. So very senior guy, strategy consultant. So knows how to do really research and strategic thinking. And we incubated with him, and he's now since been kind of scaling it up. And he's hired a team of, former investors and McKinsey and Bain folks, and using then AI to help put together this research more efficiently. So gathering those insights, synthesizing that data, putting it into a format that is digestible, building it into a system that even venture firms can connect through an API eventually to use that data to help synthesize their point of view. And so we think this is a big opportunity. When people are like, "Oh, is this a venture scale opportunity?" It's fascinating. Like if you look at a product like PitchBook, most VCs use it now. PitchBook was acquired 10 years ago by a company called Morningstar. It's a publicly traded company. When it got acquired, it was doing 30 million of ARR. I think it was about break even. It got acquired for about, I believe, $160 million. Last year, PitchBook did 700 million of ARR and 400 million of free cash flow. If you look at Morningstar's business, the rest of their business has been on a steady decline. And I think the market has almost valued the rest of Morningstar's business as basically a zero in long-term value. And PitchBook has saved that business. So it's probably worth billions of dollars. It is worth billions of dollars from public market analyst views. And so what was lost was the venture industry is big. And as an asset class, it's now managing trillions of dollars, deploying hundreds of billions of dollars a year in an opaque market where now those investors have tons of fees and expenses and say, look, you should be investing that in research to figure out which companies you should pick and who you should meet with. And also that's going to get a great alignment with when you do pick with you as a investor to the founder. So we're excited. The business just launched earlier this year. We've written really interesting reports on companies like Harvey, Legora, 11 Labs, some big names, but also some small startups, GCAI, Sandstone, Crosby, as just examples. And people have found it super insightful.
And what's your official title and role there?
I'm co-founder
Okay.
and on the board. Chris is the CEO. He's driving the business. But it's a good combination being effectively, I am the customer and I know the customer really well. And, but Chris is also bringing best in class kind of research and strategy to it. As well as like Chris has been unbelievable. Like, when we talk about, I think there's the whole notion of AI native companies. Chris is like taking the red pill. He just did a demo of stuff that him and his team are building. And I was just like, oh my God, we got to show the rest of the investment team this stuff because like this stuff he's building, I was like, it is awesome. And so to just see him coming from a non-startup technical background and how he's kind of embraced it and become very much AI native, it's awesome to watch. Awesome to watch.
Well, you and your firm do so much. I wanted to see if you had any like time management tips because clearly you have to ingest a lot of information, manage a lot of people. Any like frameworks or tips you have for, I guess, budding VCs, emerging VCs, or how to just like get more out of their day and more output?
Man, I tell you, like it's funny because, we work in a business where we're investing in these operating companies, but sometimes you don't take the same best practices as these operating companies. And as a former founder or operator, like you realize the importance of focus. And so getting in line with time management is like knowing what to kind of focus on. There was a guy that used to work for me at my first startup at Community Connect, Court Cunningham, and Court's now since been a successful kind of founder operator. And Court told this story when he first went to work at DoubleClick. I think he even had a meeting. I think it was a meeting. Kevin Ryan might have been the CEO back then. And Court took this job, and Kevin said, "Okay, hey, you're in this new job, in 2 weeks, let's do a follow-up meeting, and I want you to put down like your priority list and do it in ranking order of what you think should be working on. And Court comes back, has this list. It's a full page. I don't know, it was like 30 initiatives. And I think Kevin takes a list and I think folds it from the top really kind of short. So it was only like the first 2 things. And he like tears it, right? And it was basically like out of the 30, it was just 2 things. And he was like, focus on these 2 things, forget everything else, everything will be fine. And, Steve Jobs has this saying, he was like, what he's most proud of is saying no to a lot of good ideas and focusing on the truly the most important ones. And you realize that even as a startup, like there's a lot of things that you do, but like, what are the things that really, really matter? And it's better to do those things really well than spread yourself thin and do a whole bunch of things in a mediocre fashion. And so how do you do kind of time management? I would say like you need a point in your time where you get to do a little bit of step back and come up with a strategic plan and figure out what those priorities are. And so we have all our investors write annual plans. They take a view of their book, their portfolio that they manage. They think about their markets. They think about the competition. They think about the founders they want to go after, the sectors they want to bet on. We say, hey, we want you to process all this and take real time, real thought, and then write out what your plan is. And your plan, when we prosecute it, is all about prioritization. What do you think are really the things that matter? What are the initiatives that you're going to do? And does that line to the strategic thinking of why this is important? And that's so important. And if you don't have that reset period, like you can go day in and day out, as you know, and you're just like going through the motions and you don't realize if you're doing your absolute best and most important work. And so I would say fundamentally, that's a tip. And and these plans, people are daunted. They're like, whatever. I mean, it's not hard, right? Like it could be a 1-pager, if you want to start slow. But the step back and the synthesizing and the deep thinking to come up with that, I think is super important. And I think that needs to also align with like, obviously like measurable goals and KPIs. You can say something's important, but then measure them. So for us on the sourcing, picking, winning, like those are all things we measure. Like we measure how many deals we see, we think about win rate, like all of those things. And, you can't do strategic thinking well unless you can measure the results and say, all right, this should be priority because this will move the needle or not. So I would say that's the big kind of, when I think about time management and prioritization, strategic thinking, strategic planning, and you shouldn't do what you can't measure.
I think goal setting is underrated, and it sounds like you guys do that in spades. So I'm trying to do that more at our firm, and every founder I'm speaking with, whenever they hit a blocker, I'm talking about goal setting. 'Cause I do think people can kind of get caught up in the day-to-day and not make sure they're driving towards the right things.
So easily. It's so hard for a CEO, like they get bombarded by all great ideas. And you've seen it from investors, right? Investors like, oh, maybe we should do this, maybe we should do that. And you see, the founders be like, oh, yeah, I should. And you're like, no, like you gotta like give them the framework of how you think about strategic business and then like ruthlessly prioritize. And your best investors, when they see that thinking and part of that, and then you'll be much more aligned. And so that's one of the advice I give for like even the boards I'm in, boards I'm on. I'm like, help the investors get aligned on how to prioritize, given those frameworks. So talk about your strategic plan, talk about what you're measuring, and then work backwards. And then when we bring up ideas, you can point and say, hey, is that going to really move the needle on like what I'm thinking I have to be laser focused on? And I think those are the best boards and the best founders.
And while you're great at goal setting and prioritization, I've also seen you be very generous, right? You give a lot. You're focused on building the ecosystem and supporting up and coming managers. Maybe just tell me like how you think about that. Maybe it's just who you are, but I also just want to hear like how you think about it and why it's important to you, and maybe some of the things you're working on. I could think of so many, but I'll let you speak about that.
I got this insight, and someone gave me this like kind of advice or this insight about like their kind of philosophy around luck. And of luck, people think it's like random, but this person feels like, everything's a math game and probability. And the more you somewhat give back and help people, it creates more opportunities because those people become your advocates. And they want you to win also. And they lead to opportunities, and they increase your chances of the probability and so his point was like, it may seem like luck, but it's not. And he said the reverse is also true. If you do a lot of bad stuff, there'll be less opportunities because these people aren't your advocates, and sometimes they'll be detractors or enemies. And what will seem like bad luck is really because you kind of made your bet that way. And look, and part of it is, I think it's the nature of who I am. Like I enjoy trying to help people, and it's really rewarding. And again, getting back to that story about Bob and how he influenced my life and gave me a chance and supported me, I was like, wow, shoot, if that can be part of my life's work. And when I look back on the scoreboard, and it's not just about returns, but also about what people say about me, and did I actually help them and change their kind of inflection points? I'll have a lot less regrets when my time's pass. So when I look about even my journey of the things of like, meeting Bob, playing basketball, and then getting the opportunity to write his coattails, I think that falls in line with it, right? It's like, he asked me to grab lunch so he can run some ideas by me. I could have easily said, I don't know if it's worth my time. But I was like, yeah, you seem like a really good dude. Let's do it. And so people like will say, well, they love talking about basketball story because they feel like it's so lucky. But I'm like, I think it is definitely luck. But I increased my odds. I definitely increased my odds by doing, by giving. So it's a message I try to instill in my kids and friends and people I work with and my firm is, that kind of effort. And when you think about that, will create more opportunities.
The abundance mindset is just coming through. I love it. I want to get a hot take from you on maybe what you think most VCs are getting wrong, or any contrarian view that you have.
One of them is, a lot of things that we're doing, which is a lot of VCs talk about how bigger funds will have worse returns. And people will point to data and say, oh, look, smaller funds outperform bigger funds. What they kind of miss out of that is not necessarily about size, it's about what stage you're investing in. So smaller funds are generally early stage funds, like seed funds or Series A funds, and big funds are usually growth funds or multi-stage funds, but most of their capital is in growth. And if you think about risk return profiles, if you're investing in a later stage, you have less upside. And if you invest in early, you have more upside because your cost basis is so much lower. So inherently, like, your dispersion of returns are going to be much wider in early stage, right? You can have a Coupang and suddenly be like, wow, that was 1,000x. You're not going to have it like investing in the pre-IPO 1,000x. But you can also have a lot of companies that fail in the early stage. So when I mean dispersion, you can look at one fund and be like, wow, that fund ended up being a 50x. This other fund was a 0. And your dispersion in later stage will be like, oh, that fund was a 3x and maybe that fund was a 1.5x. So that's the difference. And so when people report like the best funds is really because of like, yeah, if you take the best of the high dispersion, you're going to say that's a smaller fund, but you have to count the dispersion, right? Like the notion of volatility and that's to me risk. So people kind of lose sight of first principles and say it's not really the size, it's the stage. And that's why I argue, at least on our front, we're scaling the size of our seed firm, but it's still focused on seed. And so people will be like, you're going to have worse returns because you're selling the seed fund. I'm like, no. I think we're going to have even better returns. And I would say, we just raised our current fund, but the prior fund, which was also pretty large, probably at least in the top 5% in size for a seed fund, is on track to be our best performing fund yet. And showing that like, hey, scale was not what drags down returns. It was like us focusing on early and using those capabilities of focusing on early to find alpha and reduce that dispersion and have more winners has been really like the key thing that some people get missed in this industry. So this whole notion of like, big funds, small funds, and what's going to happen in the industry. I think a lot of people get that wrong.
And I want to close out just talking about maybe legacy and the legacy you want Primary to leave.
I tell people all the time, like people ask me, especially founder friends, are like, when are you gonna get back into like just operating again? And I tell them all the time, like this is as entrepreneurial as I've ever done. But more importantly, I'm getting to build a venture firm that I wish I had when I was a founder. That I wish I had as a founder. So this story of like being great partners and helping founders, being a founder is such an important part of your life journey. It's like this huge inflection point. You're basically betting on yourself, right? And so I meet people all the time that are like, I'm thinking about being a founder. It's so risky and blah, blah, blah. And I'm like, I get it. And like, you're taking a bet on yourself. And, there's so much self-doubt and it's keeping you up at night and it changes your life in so many ways. And to help people in that journey, I think you just build this like deeper connection with, and then whether it works out or not, I think that deeper connection is incredibly rewarding, right? So even founders that I've worked with that startups didn't go well, I think being in there, part of the trenches and part of the journey and saying, hey, I'm betting with you. And even if you fail, I'm sure you're going to be successful in life still. But if I can help you along it, I think it's going to be an incredibly rewarding journey. And so, yeah, when I think about my kind of life's work of like, if I can look back and say, wow, these are all the relationships I built and the connection that we had and the journey we went through together. And enjoy that journey together. I mean, it's hard not to look back upon it and feel like fulfilled. So I'm getting to do what I love, and it's tied to kind of what I wanted to get out of also life, which I feel really blessed.
It's a great note to end on. Ben, thank you so much for joining us. I love the conversation.
Thank you, Jared. Appreciate it.